The market opens in 4 minutes. You've been here since 5:47 a.m., surrounded by 3 glowing monitors, a cup of coffee already lukewarm, and a forlorn stack of pitch decks no one will ever truly consider. You are 23 years old, burdened by $94,000 in student loan debt. Your starting salary, which once felt enormous, now seems almost negligible compared to the astronomical sums your managing director generates in a single day. So, you run the numbers. You meticulously format the models. You don't complain, you learn. You master the art of dissecting a 10K report in 40 minutes. That's simply the bare minimum for survival at this cutthroat level. And then, one ordinary morning, you discover it. A single number, incorrectly placed. It's buried deep within your senior associate's meticulously crafted financial model. An error, small in its origin, but worth a staggering $2 million in potential impact. You stare at it, a cold dread creeping into your stomach. Silently, discreetly, you correct it in your own working file. You breathe no word of it to anyone, for you've learned quickly that this system doesn't reward raw honesty. It prizes discretion above all else. Your days stretch to 14 hours, sometimes 18. The sheer count of them ceases to matter after the first brutal month. You keenly observe which managing directors command influence, knowing precisely whose orbit to enter and whose to carefully avoid. You possess no power yet, but you have mapped its intricate web, understanding exactly where it resides. From a spreadsheet on the 31st floor, you process the mechanics of a $430 million deal. You never meet the client. You never step foot in the opulent boardroom. But your numbers, your calculations, are undoubtedly in that room. Your diligent work is embedded within the very core of that presentation deck. And somewhere within that detached distance, a fundamental understanding begins to crystallize within you. You are the foundation, the indispensable part of the edifice that no one ever sees, the essential component that no one ever truly acknowledges. The floor is empty, save for you. It's late. The city lights a glittering tapestry outside your window. For the very first time, your thoughts aren't consumed by your salary. 2 years later, the landscape shifts. You're in a room, not the main, executive boardroom, but the designated side room where associates gather and wait. Yet, you are there. That's the critical pivot. You are now structuring deals. Perhaps still junior pieces, but undeniably real, tangible structures. You meticulously draft the intricate terms on a $180 million mezzanine financing. For the first time, you sit directly across from a CFO. You calmly explain a complex covenant breach scenario without so much as a flinch, because you've meticulously run that exact scenario 40 times in the past week alone. That level of preparedness, that depth of expertise, is your true currency at this elevated stage. The deal in question, a leveraged buyout of a regional logistics company. A transaction that will almost certainly result in significant operational cuts and, by extension, human cost. You don't model the human cost. No one ever asks you to. Instead, you focus relentlessly on EBITDA margins, on debt service coverage ratios. You present your findings cleanly, concisely. The deal, propelled by your projections, moves forward. You collect your substantial bonus. You successfully push any thoughts of Ohio or the affected employees from your mind. You rationalize it in the same way everyone else here does. You simply ran the numbers. This is the second unspoken rule. Proximity to capital inevitably means proximity to power. And proximity to power, in turn, means proximity to decisions you might otherwise prefer not to have made. You begin to proactively build your own intricate loyalty network. A vice president who consistently brings you onto lucrative deals. A fellow associate who feeds you invaluable snippets of information. You protect each other, not out of any genuine friendship, but out of a pragmatic, mutual utility. Welcome to the first discernible layer of the machine operating within the larger machine. You are now managing people. Their output, their inevitable errors, their relentless hours. A small team of 4 analysts, 2 associates. You no longer bother counting your own hours. Your mind now operates in terms of deal flow. Not hours, not individual tasks. Just deal flow. You close your first transaction entirely independently. A $620 million acquisition financing for European infrastructure in Southeast Asia. Your managing director's name emblazons the cover sheet. Your name is relegated to page 6. But in the room, it is the client who turns to you, asking precise questions, their gaze fixed on you when the numbers become complex and challenging. That is the definitive shift at the VP level. You are no longer merely supported. You have become a dealer, a principal in your own right. You begin to perceive the underlying ethical architecture of high finance with startling clarity. The target company's pension obligations, strategically restructured post-close. The acquiring fund absolutely needs a 22% IRR. The pension restructuring, a quiet maneuver, makes that target possible. You understand precisely what this means for the retirees. You don't say it. No one says it in the meeting. The deal closes efficiently in 11 weeks. Your year-end cut is a handsome $480,000. You promptly wire $40,000 to your parents. You purchase a 2-bedroom apartment in a city where owning such a property undeniably signals arrival, a clear mark of success. You tell yourself, perhaps even genuinely believe, that the pension situation was already on the brink of insolvency anyway. You might even be right. The third rule, firmly established at the VP level, is this: you stop asking if the deal is good. You begin to ask only if the deal is executable. At this rarefied level, that single question is the only one that truly remains. You are now sourcing deals. You're not just executing the mandates given to you. You are originating them. Clients bypass your MD and call you directly. Private equity shops, recognizing your influence, route their deal flow through your channels. 3 major closings in 4 years bear your indelible mark. You have never once missed a deadline. Never once leaked sensitive information. That unwavering reliability, that ironclad discretion, is valued far more than raw intelligence in this world. You manage a formidable $1.2 billion book of advisory mandates. You now sit on pitch meetings as the senior banker, the lead. Your associate runs the intricate model. Your VP expertly coordinates all aspects of due diligence. Your role is to sell the vision, to sell absolute confidence. That, you realize, is the ultimate product you offer. You begin to grasp the concept of leverage in its purest form. Not merely financial leverage. Informational leverage. The knowing. You know precisely which companies are on the cusp of announcing a strategic review long before any public disclosure. You know which sovereign fund is quietly accumulating a position well in advance of any mandatory filing. You do not trade on this privileged information. That's not what this level is about. But you know, and that profound knowing makes you sharper, more decisive, almost prescient. Then, you lose one. Not because the numbers failed, but because of a crucial relationship you simply didn't possess. A competing managing director happened to belong to the same exclusive private club as the chairman of the target company. That's why you lost a $2.8 billion mandate. A simple club membership. You don't lose your composure. You don't offer excuses. Within the month, you've joined not one, but 2 new, equally exclusive clubs. At the director level, the deal is never, ever just about the numbers. The calls now come earlier, sometimes before the markets even open, often from unlisted private numbers. You actively manage 12 key client relationships. Each one is worth somewhere between $3 million and $40 million in annual fee revenue. You are no longer merely working for the bank. You are the bank's vital relationship with these cornerstone clients. That is a subtle, yet seismic, distinction. You sit on an internal credit committee, a request for $900 million in revolving credit, from a company with a noticeably deteriorating balance sheet. You vote yes, not because the credit is clean or sound, but because losing that long-standing client relationship would realistically cost the firm 3 times the exposure. It is a political decision, cleverly disguised as a financial one. Every major decision at this level, you realize, is a variation of this same dynamic. You travel relentlessly. Singapore, Zurich, Abu Dhabi, Dubai. You have formal dinners with ministers, not just politicians, but actual ministers of state. These are not merely business dinners. They are intricate exercises in relationship maintenance. The relationship is the business. Capital doesn't simply follow returns. It gravitates toward established relationships, political alignment, regulatory familiarity, and above all, trust between the right, deeply entrenched people. The best trade in the entire world will simply not execute without that foundational trust. Your very identity has quietly and systematically restructured itself around the machine. You don't notice it. Nobody does. Not at first. There are 14 partners in the division. You are now one of them. Your name is on the door, not literally, perhaps, but in every way that truly matters. You have a carried interest in the fund, meaning you have real skin in every major deal the firm undertakes. When the fund performs spectacularly, you perform spectacularly. When it doesn't, neither do you. This fundamental shift changes everything about how you think. You stop optimizing for the ephemeral annual bonus. You begin to optimize for the expansive 5-year fund cycle. You stop thinking in quarters. You start thinking in decades. You led a monumental $4.3 billion acquisition of a European energy infrastructure company. 3 grueling months of intense negotiation for complex regulatory jurisdictions, 2 formidable competing bids. You orchestrated the consortium, your fund, a powerful Middle Eastern sovereign co-investor, a venerable Canadian pension fund. The closing dinner is held in London. The definitive handshake happens in a room that, you notice, doesn't appear on any official floor plan. You structure the intricate offshore holding through a Luxembourg SCS car, funneling into a Cayman feeder fund. The tax efficiency is substantial. The entire structure is entirely legal, perfectly compliant. 2 highly respected attorneys, one in Dublin and one in Singapore, have blessed it from every conceivable angle. You sign without a flicker of hesitation. This single, strategic deal adds a remarkable 180 basis points to the fund's net IRR. Your carried interest on this singular transaction alone will compound to over $40 million. You gradually stop attending most social events, not because you're simply too busy, but because the conversations no longer feel useful, no longer stimulating. Your social world has inexorably narrowed to encompass only those individuals who control vast quantities of capital. Coincidentally, you have 2 such calls today. One from a sovereign wealth fund in the Gulf, seeking $7 billion in deployment. They want your fund to anchor the deal flow, a massive vote of confidence. You are one of only 3 firms they will entrust with that significant mandate. The second call is from a finance ministry, not a banker, but the minister himself. You take both calls from the same room, your corner office on the 44th floor. There are no trading screens, no buzzing Bloomberg terminal, just expansive glass, profound silence, and a phone that connects you directly to the people who move entire asset classes. You are no longer merely in the market. The market, in a very real sense, is now in you. Your positioning, your nuanced sentiment, your deployment decisions collectively move price discovery. When you buy, others watch intently. When you strategically pull back, analysts will write about it for weeks. You sit on 3 corporate boards. You advise a multilateral development bank's massive infrastructure program. You brief the government, twice a year, on the intricate conditions of the capital markets. You do not lobby, you advise. The distinction, while subtle, is real. The immense influence, however, remains exactly the same. The moral architecture becomes abstract at this rarefied level. The consequences of your decisions are too diffuse to genuinely feel, too widely distributed across too many institutions, too many layers. You don't feel the layoffs downstream. You feel the fund return. You optimize the fund return. That is the system. That is the 7th and final rule. There is no outside perspective anymore. You are the perspective. You no longer carry a formal title. There is simply a name. No designation below it. Senior advisor, chairman emeritus, a name attached to a prominent family office. All are technically accurate. None of them, you realize, truly capture the extent of your role. Stakes in 5 different funds, 2 private banks, and 1 reinsurance vehicle shrewdly registered in Bermuda. You are 71 years old. 47 years embedded within the machine. It has been here far longer than you have. 3 current central bank governors know you by your first name, not by your title, and not because you directly influence monetary policy. It is because critical information flows in both directions, seamlessly, between you. Your committee deploys capital across sovereign debt, infrastructure, equity, distressed credit, and complex currency carry structures, spanning 14 distinct markets. Total assets under management now exceed $90 billion. The exact figure is known to only 4 people. You are one of them. You don't trade your position. Trading responds to the market. Positioning, profoundly precedes it. 2 years before anyone else, you discern a major currency block facing an impending liquidity stress. You structure your holdings accordingly, not to trigger the event, but to ensure you are decisively on the right side when the inevitable arrives. When it happens, your funds gain handsomely. The press calls it prescient risk management. The true cost of operating at this level, however, is not something anyone can ever truly prepare you for. The people you can genuinely trust number fewer than 10. Beyond that impossibly small circle, there is nothing. You possess more access than anyone in your life could ever possibly comprehend, and yet you have almost no one to tell. You are too deeply embedded to ever be removed. The system, you understand, would cost far more to dismantle than it would to simply keep you exactly where you are. That is not mere power. That is something far quieter, colder, and infinitely more permanent than power itself. A boardroom in Geneva, for silent people, no agenda visible on the table, no presentation displayed on the screen. You speak for approximately 6 minutes. The room, rapt, listens to your every word. Then you stop, and the room, without a spoken command, moves. Somewhere, in a gleaming glass tower in a city that never ceases its relentless motion, a 23-year-old opens a terminal for the very first time. His badge proudly states, Analyst First Year. The badge has always said that. It always will. He thinks this is about the salary. He thinks the system rewards what you diligently put in. He doesn't yet know what the system actually rewards, but he will find out. The terminal blinks, the market opens, and the machine takes another inexorable step forward. The pre-market hush is thick, broken only by the hum of technology. The clock counts down, for minutes until opening. You've been anchored to this desk since 5:47 a.m., surrounded by 3 glowing monitors, a cup of coffee that's long gone lukewarm, and a stack of carefully crafted pitch decks that, you suspect, no one will truly examine. Barely out of college at 23, the crushing weight of $94,000 in student loan debt hangs over you. Your initial salary seemed a fortune, a golden ticket to a new life, until the staggering figures of your managing director's daily earnings laid bare the true scale of wealth in this ecosystem. So you run the numbers. You format the models. You absorb the relentless pressure without complaint. You learn to dissect a 10K report in under 40 minutes, a skill born not of ambition but of pure, unadulterated survival at this unforgiving level. Then, one unremarkable morning, a discrepancy leaps out from the endless columns of data, a single, glaring error. It's buried deep within your senior associate's meticulously constructed model, an oversight worth a staggering $2 million. You stare at it, a quiet understanding settling over you. Without a word, you fix it in your own file. You say nothing to anyone, for the unwritten code of this world quickly becomes clear. Integrity is secondary to expediency. The system doesn't reward honest confession. It prizes quiet competence and unwavering discretion. Your days stretch to 14 hours, sometimes an exhausting 18. You stop counting after the first month, the concept of time blurring into an endless pursuit of deliverables. You meticulously observe which managing directors to approach and which ones to steer clear of. You are merely a cog, devoid of true influence, yet keenly aware of the intricate web of authority, understanding precisely where real power resides within these hallowed, glass-encased walls. You process a $430 million deal from a complex spreadsheet on the 31st floor. You never meet the client, never set foot in the hallowed boardroom. Yet, your numbers are in that room. Your diligent work is embedded within that critical presentation deck. And somewhere in that vast, impersonal distance, a profound realization begins to dawn. You start to grasp the intricate geometry of this colossal enterprise. You are the unseen foundation, the indispensable yet unacknowledged bedrock upon which financial empires are built. The floor is finally empty, the hour late. You gaze out at the sprawling, indifferent city below. For the first time, your thoughts are no longer consumed by the promise of your salary. 2 years later, you're not yet in the main boardroom, but you are in the room, the side room where the associates gather and wait. But you are there. And that, you realize, is the pivotal shift. You're structuring now, handling junior pieces, certainly, but they are real, tangible components of a deal. You draft the complex terms for a $180 million mezzanine financing. You sit across from a chief financial officer for the very first time. You explain a nuanced covenant breach scenario without so much as a flicker of hesitation, because you've meticulously run that scenario 40 times in the past week alone. That level of meticulous preparation, that exhaustive readiness, is your most valuable currency at this demanding stage. The deal itself, a leveraged buyout of a regional logistics company, an operation that will almost certainly result in significant cuts to its workforce. You don't model the human cost. Nobody asks you to. Instead, you model EBITDA margins, debt service coverage ratios. You present the financials with surgical precision. The deal moves forward. You collect your bonus. You consciously don't think about the struggling towns in Ohio, quietly rationalizing it the way everyone else does. You simply ran the numbers. This brings you to the second unspoken rule of this world. Proximity to capital inevitably brings proximity to power. And that proximity to power often means proximity to decisions you might rather not have made. You start strategically building your own loyalty network. A vice president who consistently brings you onto lucrative deals. An associate who feeds you crucial, inside information. You protect each other, not out of genuine friendship, but from a mutual, pragmatic utility. Welcome to the first true layer of the machine inside the machine. You're now managing people, their output, their inevitable errors, their relentless hours. You oversee a compact team of 4 analysts and 2 associates. You stop counting your own hours. Your mindset shifts entirely. You now think in terms of deal flow, not in individual tasks or the passage of time. You close your first transaction independently, a $620 million acquisition financing for European infrastructure in Southeast Asia. Your managing director's name emblazons the cover sheet. Yours is buried on page 6. But in the room, the client is talking directly to you, asking you the probing questions, looking at you when the numbers grow intricate and complex. That's the profound shift at the VP level. You are no longer merely supported. You are a dealer, an orchestrator. You begin to see the ethical architecture of high finance with stark clarity. The target company's pension obligations are restructured post-close. The acquiring fund absolutely needs a 22% IRR. That pension restructuring, with all its implications, is what makes that target possible. You understand precisely what this means for the retirees, for their security. You don't say it. Nobody in the meeting says it. The deal closes in 11 weeks. Your year-end cut is a substantial $480,000. You wire $40,000 to your parents. You buy a 2-bedroom apartment in a city where such a purchase isn't just an investment, but a clear signal of arrival. You tell yourself the pension situation was already on the brink of insolvency. You might even be right. The third rule, firmly ingrained at the VP level, becomes your guiding principle. You stop asking if the deal is good in any moral or societal sense. You only ask if the deal is executable. At this stage of the game, that question is the only one that truly matters. You're sourcing now, not just executing deals handed to you, but originating them from scratch. Clients call you directly, not your managing director. Private equity shops actively route deal flow through you. 3 major closings within 4 years. You've never missed a deadline. You've never, not once, leaked sensitive information. That unwavering reliability, that absolute trustworthiness, is worth far more than raw intelligence in this world. You manage a $1.2 billion book of advisory mandates. You sit on pitches now as the senior banker, the one who commands the room. Your associate meticulously runs the model. Your VP expertly coordinates due diligence. You sell the vision. You sell confidence. That, you realize, is the ultimate product. You start to understand leverage in its purest, most potent form. Not merely financial leverage, but informational leverage, the knowing. You know which companies are about to initiate a strategic review before any public announcement. You know which sovereign fund is quietly building a significant position before any disclosure is made. You don't trade on it. That's not what this level is about. But you know, and that knowing makes you sharper, more decisive, perpetually a step ahead. Then you lose one. Not because the numbers were off, but because of a relationship you simply didn't have. A competing managing director just happened to belong to the same exclusive private club as the chairman of the target company. That's why you lost a $2.8 billion mandate, a club membership. You don't lose your composure. You don't make excuses. Within the month, you've joined two of the most exclusive clubs in the city. At the director level, the deal is never just about the numbers. The calls come earlier now, sometimes before the markets even open, often from private, unlisted numbers. You manage 12 high-value client relationships. Each one is worth between $3 million and $40 million in annual fee revenue. You are no longer merely working for the bank. You are the bank's relationship with these clients. That is a subtle, but seismic, distinction. You sit on an internal credit committee, a $900 million revolving credit line for a client with a visibly deteriorating balance sheet. You vote yes, not because the credit is clean or even particularly sound, but because losing that relationship would cost the bank 3 times the exposure. It's a political decision, masterfully disguised as a purely financial one. Every major decision at this level, you now understand, is fundamentally political. You travel constantly: Singapore, Zurich, Abu Dhabi, Dubai. You have private dinners with ministers, not politicians, but the actual ministers of state. These are not merely business dinners. They are crucial relationship maintenance. The relationship is the business. Capital doesn't flow based on returns alone. It follows relationships, political alignment, regulatory familiarity, and above all, trust between the right people. The best trade in the world simply doesn't execute without that trust. Your very identity has quietly restructured itself around the machine. You don't notice. Nobody does. Not at first. There are 14 partners in the division. You are one of them now. Your name is on the door, not literally perhaps, but in every way that truly matters. You have a carried interest in the fund, meaning you have skin in every major deal the firm runs. When the fund performs, you perform. When it doesn't, neither do you. This changes everything about how you think. You stop optimizing for the annual bonus, a mere fraction of the real prize. You optimize for the 5-year fund cycle. You stop thinking in quarters. You start thinking in decades. You let a $4.3 billion acquisition of a European energy infrastructure company, 3 months of brutal negotiation for complex regulatory jurisdictions, 2 aggressive competing bids. You run the consortium, your fund, a Middle Eastern sovereign co-investor, a prominent Canadian pension. The closing dinner is in London. The definitive handshake happens in a room that doesn't appear on any floor plan. You structure the offshore holding through a Luxembourg S.C.A.R. feeding into a Cayman feeder fund. The tax efficiency is substantial. The entire structure is entirely legal. 2 highly respected attorneys, one in Dublin and one in Singapore, have blessed it from every conceivable angle. You sign without hesitation. The deal adds 180 basis points to the fund's net IRR. Your carried interest on this single transaction alone will compound to over $40 million. You stop attending most social events, not because you're too busy, but because the conversations no longer feel useful, no longer align with your singular focus. Your social world has narrowed, almost imperceptibly, to include only people who control vast amounts of capital. Coincidentally, you have 2 urgent calls today. One is from a sovereign wealth fund in the Gulf, with $7 billion seeking deployment. They want your fund to anchor the deal flow, making yours one of only 3 firms they will give that exclusive mandate to. The second call is from a finance ministry, not a banker, but the minister themselves. You take both calls from the same room, your 44th floor corner office. There are no trading screens, no Bloomberg terminal, just glass and silence, and a phone that connects you to people who possess the power to move entire asset classes. You are no longer in the market. The market is, in a profound sense, in you. Your positioning, your sentiment, and your deployment decisions actively move price discovery. When you buy, others watch with intense scrutiny. When you pull back, analysts write about it for weeks. You sit on 3 corporate boards. You advise a multilateral development bank's massive infrastructure program. You brief the government twice a year on critical capital market conditions. You do not lobby, you advise. The distinction, you tell yourself, is real. The influence, you know, is precisely the same. The moral architecture becomes utterly abstract at this level. The consequences of your decisions are too diffuse to truly feel, too distributed across far too many institutions and people. You don't feel the layoffs downstream. You feel the funds return. You optimize the funds return. That is the system. The seventh rule, perhaps the most absolute. There is no outside perspective anymore. You are the perspective. You no longer carry a formal title. There's just a name. No designation below it. Senior advisor, chairman emeritus, a name attached to a family office. All technically accurate. None of it truly captures the reality. You hold stakes in 5 funds, 2 private banks, and 1 reinsurance vehicle registered in Bermuda. You are 71 years old, 47 years inside the machine. It has been here far longer. 3 central bank governors know you by your first name, not by your official title, not because you actively influence monetary policy. It's because the information flows seamlessly in both directions. Your committee deploys capital across sovereign debt, infrastructure, equity, distressed credit, and currency carry structures, spanning 14 global markets. Total assets under management, AUM, are now above $90 billion. The exact number is known to precisely 4 people in the world. You are one of them. You don't trade your position. Trading responds to the market. Your positioning precedes it. 2 years before anyone else, you discern a major currency block facing immense liquidity stress. You structure your holdings accordingly, not to trigger the event, but to be positioned on the right side when it inevitably arrives. When it happens, your funds gain massively. The press, unaware of the deeper mechanics, calls it prescient risk management. The true cost of operating at this level, however, is not something anyone can prepare you for. The people you can genuinely trust number fewer than 10. Beyond that intimate circle, there is nothing. You have more access than anyone in your life can possibly understand, and yet you have almost no one to tell. You are too deeply embedded to ever be removed. The system itself would cost more to dismantle than to simply keep running. That is not power, not in the conventional sense. That is something quieter, colder, and infinitely more permanent than power. A boardroom in Geneva. For people. No agenda on the table, no presentation on the screen. You speak for approximately 6 minutes. The room listens to every single word, utterly captivated. Then you stop, and the room, almost imperceptibly, begins to move. Somewhere, in a glass tower in a city that never ceases its relentless motion, a 23-year-old opens a terminal for the very first time. His badge reads, Analyst, first year. The badge has always said that. It always will. He thinks this is about salary. He thinks the system rewards what you put in. He doesn't know yet what the system actually rewards, but he will find out, eventually. The terminal blinks, the market opens, and the machine takes another inexorable step forward.